Understanding Mr. Market. Imagine owning a portion of a business that you purchased for $1,000. Every day, a peculiar individual, let's call him Mr. Market, approaches you with a different opinion about the value of your share. Sometimes he is overly enthusiastic and offers to buy your share at a very high price. Other times, he becomes extremely pessimistic and is willing to sell you more at a very low price. The strange part? His opinions often have little connection to the actual performance of the business. There have been times when company earnings improved significantly, yet Mr. Market still valued the business far lower than before. Should you rely on such a person to determine the value of your investment? Absolutely not. A key principle to understand is that a stock represents ownership in a real business, not just a number on a screen. Since Mr. Market is driven by emotions, the price he offers often differs from the true value of the business. This inconsistency creates opportunity. When prices are unrealistically high, it may be wise to sell. When prices drop irrationally, it may be the perfect time to buy. The beauty is that you are never forced to act. You simply choose when his offers make sense. In today's world, Mr. Market shows up constantly through notifications, apps, and news updates. However, just because he appears more frequently does not mean you should trade more often. If his offers don't meet your standards, ignore him and focus on your strategy.
The defensive investor's strategy. Investors generally fall into two categories: defensive, passive, and enterprising, active. Most individuals are better suited to the defensive approach because they have limited time and prefer simplicity. A defensive investor should maintain a balanced portfolio, often dividing investments between stocks and bonds. A common example is a 50-50 allocation, though this can vary depending on personal circumstances and market conditions. This balance should be reviewed periodically. If one asset class grows significantly, adjustments should be made to restore the original allocation. Another key strategy is consistent investing, placing a fixed amount of money into the market at regular intervals. This method helps reduce the risk of poor timing and leads to a more stable average purchase price over time. When selecting stocks, a defensive investor should follow certain principles. Diversify across multiple companies to reduce risk. Avoid concentrating investments in a single industry. Choose large and financially stable companies. Prefer businesses with a long history of paying dividends. Ensure consistent earnings without major losses. Look for steady growth over time. Avoid overpaying for assets or earnings. For those who prefer simplicity, investing in index funds can provide average market returns with minimal effort.
The enterprising investor's path. At first glance, it may seem easy to outperform the market by simply putting in more effort than the average investor. However, reality proves otherwise. Beating the market requires patience, discipline, continuous learning, and significant time commitment. Many investors, both professionals and individuals, fail because they become influenced by market emotions. History provides clear examples of how even experts can make poor judgments during periods of extreme optimism, such as market bubbles. An intelligent investor understands that company profits are limited, and therefore the price paid for those profits must also be reasonable. Instead of chasing popular or rapidly growing stocks, the enterprising investor focuses on undervalued opportunities, companies that are overlooked or temporarily out of favor. In some cases, it is even possible to find businesses priced below their net working capital, meaning investors are effectively getting additional assets for free. While such opportunities are rare, they can be highly rewarding. To succeed, an active investor must also analyze financial statements carefully and apply flexible criteria when evaluating potential investments.
The importance of a margin of safety. No matter how careful an investor is, mistakes are inevitable. The key is to minimize their impact. This is where the concept of a margin of safety becomes essential. The idea is simple. Never pay full price for an asset. Always leave room for error by buying significantly below its estimated value. For example, if you believe an investment is worth $30, purchasing it at $20 provides a cushion against miscalculations or unexpected events. This principle is similar to engineering safety. Structures are designed to handle more stress than expected. Investing should follow the same logic. By consistently applying a margin of safety, investors can protect themselves from major losses while increasing their chances of long-term success.
Rethinking risk and reward. Traditional financial theory suggests that higher returns require taking higher risks. Risk is often measured by price fluctuations. However, this perspective is incomplete. True risk is not about volatility. It is about the possibility of losing money permanently. When investors buy assets at prices far below their true value, they reduce risk while increasing potential returns. In contrast, overpaying for popular investments increases risk, even if those investments appear safe. Consider this. Buying something worth $1 for 60 cents is less risky than buying it for 90 cents, even though the cheaper option offers greater profit potential. Therefore, risk and reward are not always directly linked. Intelligent investing is about finding opportunities where high returns come with lower risk.
Premium reflections. Let's revisit the key ideas. Market prices often swing between extreme optimism and pessimism. A disciplined investor uses these fluctuations as opportunities. Defensive investors benefit from diversification and consistency. Enterprising investors require effort, patience, and deep analysis. A margin of safety is essential to protect against mistakes. Risk is determined by price versus value, not market volatility. These principles remain just as relevant today as they were decades ago. The real question is, will you apply them?